As we close 2020, the puzzle between roaring markets and a struggling economy stares us in the face. Can markets continue to hit new highs even as the economy is only slowly healing, and many economists are doubting if it will return to its pre-COVID pace of GDP growth even by FY23? To better understand the macro and the markets, I have someone who is good at both. I am joined by Neelkanth Mishra, the Managing Director and India and I think Asia Pac equity strategist for Credit Suisse in our ongoing series Outlook 2021. Neelkanth, I can't tell you how important you are to this series because, as I say, I've done a couple of market masters and economists in this series, and the views are somewhat divergent, with markets being very cheerful or market masters being very cheerful and economists being a little doubtful. So I want to start with that. What is your assessment? You seem to indicate that you are expecting that the Indian economy will grow well over 6% by the time we come to FY23. Why do you think so? Okay, well, we should be getting Neelkanth in just a minute. As always, some telecom issues. Credit Suisse, largely authored by Neelkanth Mishra, have put out a report for Outlook 2022, where they argue that the GDP growth, which is estimated by many people for FY22, largely at about plus 10-11%, is likely to bring India back to the same level we were in March of 2020. Now, what Neelkanth is arguing is that after this deep cut and this 11% growth, we won't be at the same pace as March 2020, but we will in fact be much stronger. And they have a few reasons why they think so. Okay, we've got Neelkanth back. Neelkanth, I was just explaining the first part of your thesis, that while many economists tell me that minus 8% this year, plus 11% next year will bring us back to the March 2020 level. You don't think so. You think we'll be better off. How much better and why?
Yeah, so see, the first thing is that the pandemic damage to the economy was in order to prevent more deaths and allow the economy to prepare for the pandemic, we locked down the economy. Now, the main reason why we saw a 24% decline in June quarter GDP was that the activities were restricted. So if you remove the restrictions, then of course the economy bounces right back. Now, the secular growth in the economy in the last 30 years has been about 6.5 to 7%.
Yes.
Even if you assume that in the years running up to the pandemic, we had slowed down. So if you take 6%, in FY22, we would have been 12 to 13% higher. Right? That was what the consensus GDP growth forecast was, FY22 over FY20, before we went into the pandemic. Now we are at about as you say, plus 1%. Now, if you assume that for 6 months the economy didn't grow, right? So just get it off the clock. What you get is, so you remove 1/4 of that, so 6 months out of 24.
Yes.
Then you should still be at plus 9.
Okay.
But then there is a problem, right? So there is a problem that there will be scarring, right? So the lockdown and the losses of GDP in the last 6 months will clearly have some impact on potential GDP, people's willingness to spend, people's ability to invest and all that. You take some off, but are you going to take off 8%?
Okay.
And I think that as the numbers are getting revised, so for example, if you go from 100 to 76, go back from 76 to 100, because see, the 100 to 76 happened because you restricted activity. You need 33% growth.
Yeah.
So the numbers that people have used, and I think those themselves, because these are such large moves, I don't blame them. I think the numbers are perhaps underestimated. And what is also important is that many of the headwinds to growth that we had seen, like, even March quarter itself, even the month of March itself was disrupted by the pandemic. In fact, when I look at the inflation, the fiscal numbers that I see, people forget that in the month of March, or at least in FY20, the fiscal deficit came out to be 1,60,070,000 crores more than what was revised estimate. And all of it happened because of a drop in receipts.
Okay.
Because the government allowed people. And so all of those taxes were due, right? It's not that they had to be generated in the last 10 days. So as that tax payment happens, and it is now starting to happen, you may have seen that in October, personal income tax collection was up 17% year on year. So I think the fact that the March quarter itself was disrupted, GDP growth was 3.1%, and last 15 days we saw very little activity, is something that needs to be incorporated when we are thinking of these numbers. And therefore, I think the sharp disruption has also kind of unhinged the ability to forecast. And therefore, I think there can be upgrades to FY22 numbers and also therefore FY23.
Okay. Well, Neelkanth, I want to be proved wrong, but my skepticism is that, as you say, there can be large parts of the industry which can be of demand, which can be permanently scarred. And you also point out that the government is the PLI schemes, putting money behind the winning horses, should also give a lot of points to GDP. Now, I will come to that in a bit when we discuss markets. But my point is, manufacturing is per se not a growth generator. So even if it is an output generator, it is not a growth generator. See, from 70 to 90, 1970 to 1990, we got a big fillip because we had agriculture as the engine of growth, the Green Revolution and what followed. After 91, we had a huge services growth, IT, which again is people-oriented. PLI is not people-oriented. So even if it gives output, will there be, it may not create so many jobs is what I meant. When I say it's not people, it's not labor intensive. So is there a problem of demand?
Okay, so let's first think about the problem of demand, right? So, it's important to remember that the top 10% in India consume more than the bottom 50%. I'm not talking about incomes, I'm not talking about savings, I'm talking about consumption, demand. And as we had highlighted in our Beyond the Pandemic analysis, so if you remember in early September, we came out and said the economy and the virus are getting delinked. People thought we were nuts because, there were 100,000 new cases and 1,200 new deaths, and we were saying, oh, there's not going to be a link. And we were lucky it did turn out that way, thankfully. The fact is that in that analysis, we also said that the higher income households are coming out of the pandemic with better balance sheets than earlier. And this has happened globally, it's not just in India. That you've seen financial savings shoot up, right? And that's because the higher income households, their consumption was more affected than their income. For the low income households, the consumption cannot be cut, right? And their income was affected. And therefore, their balance sheets are much worse, right? So they have taken on more informal debt or they have had to shed assets. Now, when you get out of this, again, the lower income households, the only thing they can curtail is their own discretionary demand. They're then the worst affected. But that's very little. Their total consumption is mostly non-discretionary, right? And the upper income has actually come out all guns blazing, right? Which is why you have seen demand for cars and high-end refrigerators and TVs and all of that has come out very well. So the impact of the economy. So I think this is something that the weakness of the informal sector, the weakness of the poor is something that policy needs to address. But in terms of the total economic impact of their weak balance sheets, the impact is not that. The PLI job creation, the handset scheme, the target of the government, or at least the estimate of the government of direct job creation is about 300,000 jobs, right? Now, the indirect job creation, which I assume means upstream investments, right? So basically that when you're doing a handed assembly, the objective is that over a period of time, you will get the upstream industry to come in as well. That's 900,000 jobs. In textiles and apparel, basically I think the apparel PLI is going to focus on man-made fiber. Is expected. I mean, the funds have been, what budget has been given, what the scheme structure is, we will get to know. Every $1 billion, this is what industries tell us, that every $1 billion is like 150,000 jobs. So that itself can create a lot of jobs. But see, we have to remember that if you are thinking of value add, so suppose in autos, right? So you can say that a large amount of funds in autos, how many jobs does autos create? But it's not just the final assembly folks, right? Because it's not the OEM.
It's the ecosystem.
It's upstream value, right? And the very fact, and this is again, so the remarkable thing about PLIs is not, I think what you highlighted was very important, that the government is incentivizing growth by companies by giving them monetary incentives.
Yes.
But also they're relying on champions. So they're saying that the incentive size has to be large enough so that large firms can grow. There is a third principle, which I think is even more fascinating, is that they have figured out that if you encourage downstream investment, like say handset assembly, the cost of assembly in handsets, test and assembly, is like 3 to 4%. In mid-end phones, maybe 8, 10, 12%. But the incentive of 4 to 6% is actually a very large part of the assembly cost. So that encourages the assemblers to come to India, or increase India's production share. It triggers then the upstream investment. So, so in autos also, if suppose the car exports from India go up a lot, there will be a lot of investment and job creation in the component supply chain. So I do think that there will be income generation in India.
So there is a growth multiplier that you are expecting. Now, very quickly, I have to take my first break, but I want one number from you. If the world is telling me that, or many economists are telling me, not the world, that we will be only 1% or 1.5% higher than March 20 in 2 years, what is your number?
No, I think we will be at least 4% higher, right? So, so there should be at least a 3% upgrade to what consensus is at. And I'll tell you why. Right? Over and above what I just said, that it's just an accounting and arithmetic problem, which people are struggling to give us such a high number. It is also that if you think about the PLI schemes that start in FY23, the FY23 PLI schemes will require that the investments are done in FY22.
Yes.
So the moment the firms are identified, they are going to be in a hurry to do capex. If you may not have noticed that in the handset scheme, because the revenue targets are from 1st of April 2021, companies have been using air freight to ship equipment from China to India. They're in such hurry to capex. As that happens, you're bound to see some growth acceleration.
I'm going to hurry you because I want to ask you about markets now. I take your point, Neelkanth has also argued that gross fixed capital formation already has not done too badly in the second quarter. So from your argument, GFCF will do very well in the subsequent years. As well, government expenditure is going to increase in the second half. We don't have time to discuss that. So that will be the tailwind for growth. Now, what about markets? The markets, as Neelkanth's report says, is already priced to a 21% earnings growth in FY22. Okay, so all that is in the price. What next is what I'm going to ask Neelkanth after this very short break. Welcome back to our series Outlook 2021. I've been speaking with Neelkanth Mishra, Managing Director and Asia Pac and India Equity Strategist with Credit Suisse. Before going to break, Neelkanth convinced me at least that while a lot of economists out there believe that the Indian economy will be only 1% maximum bigger than it was in March 2020 when COVID hit, he convinced me that the economy could well be at least 4% stronger. So who benefits from a market point of view? Well, Neelkanth, welcome back. And I have two sets of questions for you. One on where the earnings growth will be. And then we will discuss valuations, which is a different issue. Now, who benefits from the kind of GDP growth that you see?
So the first thing is that, and this is where the economy and the markets, the fact that they are sort of weakly linked, is something that comes up. There are 8 to 10 companies, so the 4 private banks, 1 large PSU bank, 2 auto manufacturers, and 1 large energy company, which more or less, if you get their estimates in the ballpark, then your index EPS is going to be more or less right. I mean, of course, there are other drivers as well. Now, in the past, see, currently FY22 Nifty EPS consensus is plus 40% and FY23 is plus 21%. Now, people think that FY23 is too far, but if you look at the markets in December 21, we will all be thinking only about FY23, right? So
Yes.
how FY23 moves is very important for us to figure out where the market goes. Now, however vague it is, I mean, that's the whole challenge, right? The past trends are not very encouraging.
Oh,
right?
yes.
So in the last 7-8 years, in each of the years, from the first time an index EPS was introduced to the time that it became actuals, the cuts were 10 to 35%.
Yes,
right?
I remember that.
Yeah, so it is not a very encouraging sign. But at the same time, if you drill down into the sectors that drove those cuts, you find that 30 to 40% each of the cuts in those years, the
Was
worst
financials.
years, was private banks and consumer discretionary.
Okay.
Now, if in these two sectors, you are reasonably sure that the numbers are not going to get meaningfully revised downwards, and I think that there could be a reason to upgrade, you are reasonably sure that meaningful cuts, and see what matters is what will happen to FY23 in the next 6 to 9 months.
Okay.
And I think that as the market starts to build in and realize that the growth momentum is perhaps going to be a lot better than what the statistical numbers have been used so far, I think the numbers will start getting bumped up. And we have to remember that FY20 for many of the consumer discretionary names, especially auto names, was very bad.
Yes, very bad.
And the growth numbers have been built on top of that. So if you think about the 5-year or 10-year CAGR in, say, car sales in India, I think there is scope for significant upgrades there. So we think that the numbers, the fact that if they don't get downgraded itself is a positive surprise to the market, because the market is anchored to cuts.
Okay, wait, 1 minute. Now, I have a lot of viewers who are, stock market aficionados and investors. So you are saying that private banks and autos will not see cuts. But what I'm asking you is, since you're betting that the earnings growth will be 21%, maybe even better, is there any space to buy any of these? Would you buy private banks? Would you buy, what is still good value?
Yeah. So private banks I would buy. See, the thing is, if the economic growth is positive, the biggest beneficiary will be the financial system, right? Because the credit growth will pick up. And if our outlook, and so we have upgraded industrials to overweight now, partly because I think the growth surprise is better, partly because we think the fiscal situation of the government is far better than what people are currently projecting. And therefore, the state capex and the central sort of support to spending, etc., will be there. But also because, as I was saying before we went into the break, that the capex that companies do once they win these PLI incentives, the few firms that are handed over these incentives, will be accelerated in FY23. So they will be,
So it could be better than 21%, you think? There's a good chance that the FY23 earnings growth can be better than 21, you think?
It is possible. It is in the realm of possibility. But what I'm saying is that even if we achieve that, I think the market will do fine.
Will do fine. Okay. I have one doubt which you are not addressing in your report. I'm sorry I'm hurrying you, but I'm trying to fit that point in. See, a 40%, of course, is because of the base, a 40% earnings growth in FY22. But if you have to do a 21% on top of that, we need a clement global, ambience. Are you sure of that? Because, in the past, the 2003 to 2008, near double-digit growth was possible in many countries, not just India, because globally we were on the front foot. Will that be on our side?
Yeah, so for that to happen, I think, so we have to see what are the sector-wise contributions to index EPS, right? And if a meaningful part of that is actually coming from the private banks and the one large PSU bank, then the comfort actually goes up. That the driver is not in a global build-up, but it's actually more local.
Okay.
And there's some large IT services and one large global automaker listed in India, etc. I think there are some global elements there which I think are at risk. The metal sector, which we have tactically gone overweight on. I mean, we were overweight and we've sort of added to it because I think the iron ore prices are doing what, as an ex-metals analyst, I never thought I would see again, like, $120 iron ore.
Yes.
So, now it's 150, 60. So the thing is, the cash flow generation in metals is, I think, super strong. So that's more like a tactical thing. I think that as the global IP normalizes, and so I think there's another maybe 5-6 months of growth there left as the normalization happens. And once that happens, I think the flare up that we are seeing, the supply chain bullwhip going up, is perhaps going to fade.
Okay.
But look at the global trends, right? In the aftermath of the GFC, the global financial crisis, the consensus, or rather the standard policy prescription, was that you do kind of fiscal consolidation. They did some bank recapitalization, but otherwise that, and monetary easing. This time there is fiscal easing and monetary easing.
Yes.
And yesterday's retail sales data from the US would have been very worrying for the market, right? If it was a normal year.
Yeah.
But very soon it was taken over by the size of the next stimulus package that is being approved.
Fair point.
Right? So I think
So it's good to bet on a clement global economy.
Yes.
I'm hurrying you now because I have just like 1 minute for the last question. Would you say that 2021 could be the year of the mid-caps like 2017 was? Because there could be a groundswell of economic growth.
I do think so. So at this stage, it's not a very informed view, but meaning that we have been spending time figuring out the macro and the PLI schemes and the impact. But I do think that there will be several mid-caps, which partly became mid-caps because the industrial demand growth had been anemic for like 5-7 years, which will, I think, see some good traction. And I would also expect that many of the PLI schemes, like say in textiles, in medical devices, will actually identify companies which in those sectors are champions. I mean, in the larger scheme of things, they are mid-caps, but they are larger firms in those sectors.
Absolutely.
Food processing, marine exports, so things like that. Those firms can see good traction. So I traditionally, I'm very hesitant to classifying mid-caps and small caps as an asset class.
Yeah.
I would rather look at subsectors. I would rather look at companies. So yes, but I do think that many mid-caps will benefit from the trends that we are predicting.
Okay. Without naming names, you've been as helpful as possible for our viewers, I think, and certainly for us. Neelkanth Mishra, thank you very much for joining us in what was a very enlightening, enriching conversation. I do hope you have personally a very good 2021. Very quickly to recap what Neelkanth has said, against the consensus economist expectations that in FY23, the size of the Indian economy will be only 1% over what it was in March of 2020. He believes it could be a good 4-5% larger. Also, the current expectation is that the earnings growth in FY23 will be 21%, something which everyone thinks will be brought down. Neelkanth is fairly confident that because of the PLI schemes, because of better ability of the government to spend in the second half of the current year and next year, we could actually see that earnings growth even improve. So betting on private sector banks, on autos, consumption, discretionary consumption, and even in capital goods like L&T, you have all those details running for you. Thank you very much for joining us on this special Outlook 2021.